got to switch us to portrait. Oh, okay. All right, here we go. Um,
There's some static or feedback or something coming through. I don't know if you hear that.
are you hearing it on my end?
I just hear the audio coming through. Yeah, it just sounds like white noise.
I don't hear it, so that's probably good.
Your background picking it up? I'm not sure. I definitely hear it.
Yeah.
It just like it's like static
Okay.
or what.
Hang on. Let me make a switch here and see. Let's take a look at. I'm going to do a little noise suppression. So, normally I don't have to do.
Yep.
That fix it.
It made it lower volume, but it also made you low volume now.
Okay.
That's better. That's better.
Okay. Cool.
I think you're good.
Yeah. The good news is it's coming perfectly on my end, which is I think I have the
Okay.
master. So I think we're
Yeah.
good.
Perfect.
Like I told you that. All right. Here we go. Right. Welcome to another episode of Keeping It Real, the largest podcast made by real estate agents and for real estate agents. My name is DJ Paris. I'm your guide and host through this show. And today is our monthly series, Learn with a Lender with Christian Bachelder. I'm going to tell you more about Christian, and then I'm going to ask you to help us out with your next transaction. So let's tell you more about Christian. Together with David Green, by the way, if you don't know Christian and David, they became super well known on a great site called Bigger Pockets, which is a place where typically people learn about how to become real estate investors. It's the largest forum in the country, and they became very, very popular there. And so after sort of working there, David and Christian co-founded their own firm, which is called the One Brokerage, deemed the fastest growing broker in the nation in 2021 and 2022, ranked in the top 20 of brokerages by funded loan volume. Christian is a UC Berkeley grad. He has a bachelor's in chemical engineering, but he hated that industry and wanted to get out of capped earning potential. He got into real estate with the help of a childhood family friend and had some success in the business and discovered he had a knack for connecting with people and adding value to their mindsets, investments, and journeys. He's a licensed real estate, insurance, and mortgage broker. Bachelder regularly hosts masterminds, seminars, and webinars with real estate gurus. He teaches people everything from investing principles to how to buy your 1,000th property with a focus on what markets to target, how to find the best loan, and how to protect one's investments with insurance policies and other forms of asset protection. This guest speaker purchased 15 properties himself in the last 12 months, employing the same principles he teaches you. He created a course for loan officers to enroll to teach the fundamentals of the sales process, how to become the best advisor possible, how to get the most out of that career path, and tips on succeeding in any market. I want everybody on your next buy-side transaction, if you find value in our podcast, and I know you do because you're always telling me and our team that you are, and we appreciate you, and we want to continue providing this service to you. I want you to give Christian an opportunity for your next loan, whatever your clients' needs are. He wants an opportunity to chat with them to see if he can give them a great option. So you're going to go to the1brokerage.com, and that's the number one. So the1brokerage.com. We'll have a link to that in the show notes. I also want you to follow him on Instagram, which is the _1_brokerage. We'll have a link to that in the show notes. He's got 300,000 Instagram followers, guys. He's got a great following and lots of awesome content. Christian, welcome back to the show.
Absolutely, happy to be here. It's a hell of an intro. I appreciate all the kind words, and and if anybody out there is listening and does want to take a peek by our website, or obviously talk with me individually for your next deal, whether it's for you or your clients, I'd love to help. Give me a shout anytime.
Yeah, this guy is an actual legend in not only the real estate investing space, but the loan space and also the real estate broker space. He is kind of a renaissance man in this industry, well known. It's kind of a celebrity, and we're super lucky to have him. And he is coming to us all the way from LA, which we are excited to chat with him about. So, Christian, I know a lot of agents these days. It's a tough market out there. It's tough. Inventory's low. Rates are a little bit higher than anyone would probably prefer, but still not too bad. But we're having certainly seeing a lot of news out there with the Fed. I saw today Trump said he is not interested in firing Powell, the head of the Fed, but we'll see what happens. Of course, that his opinions and mine changes seemingly day to day, but certainly the market responded. I saw the Dow did well today, which is exciting. So it looks like at least the the equity markets are responding favorably. But of course, as realtors, we want to know about rates for our buyer clients who are sitting on the sidelines. So again, nobody has a crystal ball, but what's your take on everything that's going on?
Very interesting, very tough to predict. And coming from me, that means a lot as somebody who is ridiculously studied in the industry. I literally have made a career of obviously giving advice and educating. And obviously, the most common question that I get is, where are rates going? Right. That's what everybody wants to talk to a lender about. Right. What are rates? What can I get my debt at? And if you're in escrow, it's when should I lock my rate? Right. Are they going up? Are they going down? What should I do to compensate for either? What's the best direction I need to take? And I will tell you, these last, call it 3-4 weeks, have been the hardest time period to advise since I've been in the industry, which is a decade plus now at this point. Gosh, 15, 17 years, something now. Crazy. 15 years. I think I got my first intern job in the industry. But still, regardless, harder than COVID when the whole world thought it was shutting down, right? And it was not this difficult to predict rates. Now, granted, at COVID, everybody was happy with the rates because we were talking about a 2% going to a 3%, right?
Sure.
Now, obviously, with the rates being where they are, it's a little different. But what I will say, to just give kind of a general standpoint, is really what I'd like to convey to the audience in this episode is helping you guys understand not only what the market does, but understand kind of how in the back, kind of in the background, what is eventually leading to these rates, right? What's leading to the increases? What's leading to the decreases? What is impacting them? It's not really what you would think. A lot of people wait for Jerome Powell to come out in his monthly press conference and say, we're raising or lowering rates. And they say, woo, mortgage rates are cheaper or more expensive. It's not true. And, me and DJ were talking earlier and we said, hey, why is it, when the Fed cuts rates, there's not always a one-to-one correlation, right, with mortgage rates coming down. And we're going to get into that today in detail and give you guys a little more concrete understanding behind the scenes. And most importantly, give you guys some good content to use on your calls with your clients.
Yeah, let's dive in. So right now, there's a lot of uncertainty. The stock market has certainly been up and down, and some value's gone out, it's come back, and we're just consumer confidence is kind of in a strange place, and the banks aren't totally sure what to do, I think. And so, what are you seeing out there?
Yeah, uncertainty. Let me give you guys a gist of what actually happens here. Let's just use tariffs as an example because that's our common current event right now. When Trump first announced them, the stock market dropped significantly, and I'm talking, it was like 4 to 6% for like 3 straight days. Because I remember it happened on a Wednesday, and it was Wednesday, Thursday, Friday, 3 runner days where we were talking recession, and everybody was on fire, and
Brutal.
Now, the mortgage rates did great. Over those 3 days, we dropped about a full percent in mortgage rates. We were hovering around a 6.9 when it started, just as your average 30-year conventional rate. And we actually got down to like 6.25. So almost, 0.75, getting close to a full percent drop. In the course of 3 days, that's like incredible movement. Now, why does that happen? A lot of people can say, oh, well, the mortgage market and securities, which is the stock market, a lot of times people say incorrectly, but they say commonly that they move inversely to each other, right? So if the stock market goes down, mortgage rates will get better, right? Which means lower in our case. Now the reason why that is because of how the investing kind of infrastructure works in America. When money is retracted from the stock market, obviously that will lead to decreasing stock prices, right? There's less buyers, which means that there's not as much demand. So they have to drop prices in order to incentivize, right? When money exits stocks, Facebook, Amazon, Apple, whatever, it needs somewhere to go. And historically and somewhat traditionally, that money will typically retreat into the bond market. Now, so you guys understand bonds, it's basically government debt, and mortgage backed securities are a form of them, right? So when they enter the bonds, leave the securities market, securities of stocks, and enter the bonds market, that typically has a downward pressure on interest rates. And let me say this in a way that is super easy to understand, and you guys can kind of copy and paste this conversation with your clients, and you sound super smart, right? Say securities and bonds and all these fancy words, right? So as money floods into the bonds market, there's now more buyers. So consider this like your house, right? The bond market is your house that you're making an offer on. Imagine you went from having one buyer where you're probably going to get bid down and get an undervalue offer, right? And now you have 15 buyers. Everybody's scrambling. It's COVID 2020 all over again, right? Every house has 25 offers on it. That's what happens when money floods into the bond market. So because of that, because there's an influx of buyers, the rates can think of it this way: the people issuing the bonds can get a better deal, which means they don't have to pay as much return, right? Because more people want them. So it's inverted because a better return is a higher rate, but that's worse for us. So being a less strong investment to the person buying the debt, I want to make sure I'm being clear here because this gets a little complicated. They can drive the rates down because they don't have to pay as high of a return. Okay.
Right.
So typically, when something like what happened a few weeks ago happens, the rates will do great. And they did for 3 days. The problem is that money did not flood into the bond market. And this really diverged from what the expectations was. So what happened is all this money retreated from the stock market, and banks prepared. They dropped all their rates because they expected that money to flood into the bond market. And it didn't really happen. So if you follow and you track the 10-year treasury yield, which is a rough correlation to where mortgage rates are, you'll be able to see a huge drop for 3 days and then a huge spike up. And now we're actually sitting higher than we were before. The reason being, the buyers didn't come. So you guys list the equivalent to this is you guys listed your property at a super low price because you were expecting to incite a bidding war, and it didn't happen. The buyers didn't come. Now you're sitting there with the house that's underlisted, and the buyers and the seller's mad. What do? You kind of showed all your cards, you put it out there, and you made a miscalculation. That's what banks did a few weeks ago. Now this is in a bottle, but it gives a good understanding into banks don't respond to actions, they respond to news. So for instance, when Jerome Powell comes out, and just for reference, Jerome Powell is the head of the U.S. Fed. So he's the chair, right, of the Fed. He comes out and he's the one who kind of determines the monetary policy in America, right? When he comes out and he says, "Hey guys, great news, we're going to drop rates." The banks knew he was going to say that 3 months earlier.
Sure.
They already made their adjustments. Well, let me give you an example of what could happen. He could say, "Hey guys, we're going to drop rates this month, but our next 6-month period, we're anticipating increasing rates twice." If that would be a super rare scenario because he wouldn't drop and then immediately re-raise. But let's just imagine it was. On that day where Jerome Powell dropped rates, mortgage rates would actually go up because the banks would be pricing in those future 2 increases. So that's where people don't really understand that they just sit there and wait for Jerome Powell to say what he's going to say, and you're listening to the wrong part of the conversation. You should be listening to what he says is coming, not what he's doing today. That will impact mortgage rates, right? Give you a little background. Yeah, that was a mouthful, but that's a 5-minute rundown of the bond market in America.
No, I love it. It's super helpful. And also we should remember too that rates are always, something that obviously are beyond our control. And also, just kind of is what it is. And there's opportunity. It's kind of like you were saying, watching for the Fed to react isn't really where the news is today. It's where the news is going. What he's going to do in the future is what's the news today.
Exactly.
In other words, like, when prices fall and everybody freaks out, it's really the best time to buy. So
Yeah.
what we're talking about here is another opportunity that I want to encourage our agents to consider, because right now we have a lot of clients that are sitting at 2.5%, 3% mortgages. They don't want to move. They certainly don't want a 6.5% mortgage, to go from 3 to 6.5 unless they have to. But I would say maybe they would want to do that if prices were low, because not as many buyers are in there competing. So again, it's not going to be like this in every particular situation, in every market. Certainly there's always buyers out there for the inventory that's there, but there's a lot less of them right now. So if it was me and I have a 3% mortgage and I don't want to give that up, of course, but I have to think about my future and I have to think about what I want to do. And do I want to pay a premium when rates come down because now I have 20 other offers I have to beat in the market? I wouldn't want to do that. I'd rather eke it out now and pay a little bit more for however long I have to before I can refinance and get the deal I want and date the rate and marry the home, right? And I know that's not always the most comfortable conversation to have with someone, because you're asking them to spend more money for something that they're currently getting a pretty good discount on. But it's a temporary discount. Unless you're going to stay there for 30 years, then I guess it isn't. But most people don't stay in their home that long. For certainly first-time home buyers aren't going to do that. So I think anyone who's bought a home in the last 5 years, the rate, we know the values have gone up, right? So you have an opportunity to say, hey, let's take some of the winnings. I know it's going to suck because you're going to have to pay, for something, and you're going to get a loan that you're not going to love, but you might get the place you want for a little bit of a discount today. And we're going to refinance in a couple years anyway, most likely. So I think we should be having that conversation. Curious to get your thoughts.
Yeah, it's what I typically advise people is there's a lot of truth in what you just said, right? Where the only thing that you lock in when you buy a home is the price. That's the only thing that's guaranteed. Nothing else is guaranteed. Your insurance isn't guaranteed. Your property taxes isn't. Your interest rate isn't. Nothing's guaranteed because all of those things are subject to change. The one thing that you do lock in is the purchase price. You will never have to rebuy the house, but you could refinance, right? Now, I want to be careful here because I've made a career over trying my best to give, honest and the best advice I can, and not be, a pressure sales or a pitch, right? Here's what I would say. The house, and always the advice that I give clients, the house and the numbers have to work with who you are now. And if they work better with who you are in the future, that's a cherry on top. But you now is the cake, right? And if it's, hey, Christian, I'm buying this house and it will only work, whether it's flexibility for you financially, whether it's an investment in the future, whatever, if it will only work in the event you refinance, I would say don't buy that property. Let's find a different one.
Yeah, that's
Find
scary.
something
That's a
that
scary
works
situation. Yeah.
now. It may not be the golden goose right now, but it will work now. It's feasible. You're not spending the last dollar on your bank account. You're not cash flowing thousands of dollars, negatively cash flowing thousands. It's not a sink, right?
Right.
If it's something that you can tolerate, that you think is in, and obviously everything else coming into play, location and appreciation and, value add that you may do, right? If the property has enough pros and in the future, you take that 7% down to a 3.5%, awesome. But I always tell people expect to have the loan that you have now forever.
Yeah.
But you won't. Nobody
Right.
will. All those people who got 3% interest rates in COVID, I know it sounds crazy. The vast majority of them will not have them in 25 years. They won't. And
100% agree. Because
everybody says
they won't live there anymore. Yeah.
yeah. And everybody says I'm going to keep my 3% rate till I die. Sure. The average American, I think it's 6% of people, I think, keep their 30-year loans to maturity. 6% of mortgages. There's a 94% chance you're not, right? And those people who are in the 6% are the few that this is my forever home. I'm never refinancing and I'm never moving. Okay, that is some people, but it is more likely than not the client you're working with, right? And it's important to advise people to know the upsides, but also realize, hey, let's protect your financial security. invest confidently, invest defensively, and ultimately make a decision that's going to push you forward, not be the anchor at your heel, right?
I want to, yes, agreed. And I got really excited. We talked recently, and you gave me an idea that I'm embarrassed to say I hadn't thought of. And it was such a great idea that I told my girlfriend. We are in the process of kind of moving our life forward and, talking marriage and kids and all that, and looking for a house together and that kind of thing. And sadly, I would love to keep my home, even if I had the ability. I have a condo. I would love to keep it and rent it out. I don't think I'll be able to do that with the HOA rules. So sadly, as much as I would love to just keep that 3% for the next 30 years and have a renter in there, I don't think that's probably going to happen unless I get super lucky. So I'm going to have to give up that rate anyway. But what I was really excited to hear from you was a strategy that I'm sure you're not the first person to say it, but you were the first person to say it to me. And I suspect most of our audience hasn't heard it either, was the strategy about, and especially with the fact that our own 401ks or our SEP IRAs, whatever we might have for retirement, took a bit of a tumble, or at least a roller coaster ride the last few weeks, and we got a little nervous. And thank God I didn't have to retire 3 weeks ago. That would have been, or 2 weeks ago,
Yeah,
I would have been pretty unhappy. My dad is in the
100%.
process of retiring this July, and so he's kind of sweating a little bit, but
It's a
he'll
scary
be fine.
time to retire right now, 100%.
It's a scary time to retire, but but I did love your idea of buying a home a year and making an investment property, rather, not a primary residence every year, but certainly buying an investment property a year and making that a retirement vehicle for you. And I think not only is this a good opportunity for agents to consider for their own retirement, because a lot of us don't have the opportunity to work at a corporation that provides 401k matching and things like that. We're a little bit disincentivized to do that, which just kind of the way it is being an independent contractor. But we do have the opportunity to have a little bit more knowledge on the real estate investing side. And I also want to make this point, and I want to get Christian's take before we talk about the strategy, to sort of explain why it's so important to do this now. And I was talking to a real estate journalist. I have a guy on my show every month, and Chris. Chris is amazing, and he talks a lot about what he thinks institutional investing buyers are doing. These are BlackRock companies like that we all hear about, and they're buying up everything that we see. And he believes that if you're not out there investing in the next 5 years, they're going to have a good chunk of the inventory. They just have they have the cash, they have the capital, and the prices are good. They are going to gobble up a lot of what is not going to then be available for you to consider investing in. So he's like, if you don't own a home now, even a primary residence, he's like, I bet you're going to be renting in 5 years from a company like that. Now he may be wrong, who knows? But they're certainly very aggressively purchasing. So I want to then now, with that knowledge and probably some urgency, to consider. First of all, I want to get your take on that. Do you think the institutional buyers are gobbling up just a ton of inventory, and do you see that being a problem for individual investors, in the future? Of course, it always could be. But then I also want you to tell this strategy about how you could fund your retirement through real estate investing in a pretty simple process.
Yeah, 100%. Answering them in order. I would add an asterisk to the institutional conversation, and I think there's an even bigger percentage of that people don't consider. The BlackRocks and the State Streets and the Vanguards. It is true. They did go on a buying spree of single family homes, and a lot of people have very adverse reactions to that, and understandably so, because BlackRock probably shouldn't be owning single family homes, right? Have them go buy the huge 4,000 unit apartment complexes and whatever, right? However, I think there's a bigger game at play here. Sorry, 1 second here.
No problem. We are a dog-friendly office as well, so thankfully you're not hearing barking on my end, only on Christian's end at the moment. But it is not uncommon for us to hear barking in our office because we love dogs just as much as Christian does as well.
Sorry about that, guys. You saw
No
the neighbor
problem.
coming over on the window there. Okay, but what I was saying is that I would say that exact same conversation is very important to discuss. Just remove institutional. I think investors are gobbling up all the inventory. People
Sure.
like me people like
Yeah.
David Green, people, and it's not like I'm solo going to make an impact on the housing market, right? You mentioned on the intro, I bought 15 homes in a year. That's great. It's not like data moving numbers. However, 1,000, 10,000, 100,000 me's nationwide, that's significant. Now, people can call me the bad guy and, landlords buying up all the real estate. But in my opinion, it's the only way to stay ahead right now that I can see. I don't have a lick of confidence in the stock market. I don't have a 401k. I don't have an IRA. I don't want one. Right. Um, if I told you guys that, hey, I have an investment for you, you can't touch it until you're 65. And when you take out money, you're going to be taxed at a higher rate than you're taxed now. Oh, but it's tax-free growth, tax-deferred growth. Come on. So is real estate investing if you use deductions correctly. But I digress.
Correct.
My point is that yes, I think there is what we're witnessing is a mass consolidation of real estate ownership. And I don't think it's just into the institutional buyer's hands. It's into your everyday investor's hands. And we talked about this on my first appearance on here. And I implored the listeners to do a little thought exercise. Go back to your childhood, 20, 30, 40, 50 years ago, whatever. Go back to when you were a kid. How many people did you know that owned multiple houses?
Zero.
You didn't know
Maybe
any.
somebody with a home, if they were wealthy, they had a vacation
Yeah.
home somewhere, they weren't
They had
renting it
that.
out.
That was
Yeah,
about it. They had like a lake house.
that
Or
was
like,
it. Yeah,
or like the ski cabin up in the mountains, right? Like,
right.
grandma,
But it wasn't
grandma took the
wasn't
family
being
up.
rented. Yeah, it was just sitting there dormant, a cabin in the woods kind of thing. Yeah,
That's exactly right. Now, compare it to today. You can probably name 10 people without even giving
yeah,
much of thought to it of who own multiple houses, right? That's what we're experiencing, where I think there is a movement from 30 years ago. First-time home buyers were the primary movement, the moving force in the industry. And it's really, really, really started to pivot towards investors. And I would like to get it back towards first-time home buyers because I think people need to buy real estate. Like, just fundamentally speaking, in the American economy, the way that we're structured, with the way the tax code is, like, God, guys, if you don't like paying taxes, buy real estate, please. Like,
yes,
buy real estate. It is so unfairly in real estate investors' favors, the tax code, the entirety of the whole tax code. Everything else sucks. Right? Investing in stocks sucks. Capital
yes,
gains sucks. Income tax sucks. Property tax sucks. Everything else sucks except investing in real estate. It's like the only thing that can possibly be fully shielded from taxes, right? It's serious, guys. Go read the tax code if you don't believe me. Ask Donald Trump how he became president. Donald Trump became president on the heels of real estate. Like,
yeah,
it's real estate got him there, right? Regardless of your opinion of him, that's a fact, right? Your second question, kind of pivoting that on that topic of investing in real estate, my strategy, and I'll be quick because on my previous episode, I know we dove into detail, but the process is if you were to take the money that you would put into a retirement account, whatever, if you have household family income, two people making 50K a year, you got 100K in household income, you're probably putting 15K into a 401k,
yeah,
right? Together, both of you combined, 15% of your income. Maybe less, but we'll just use that number. If you were to instead take that and buy a new home once a year, and I would even argue, like, make it your primary, right? Like, when you're young, move around a bit, right? When you can be a little uncomfortable, right? Put 5% down of a $500,000 house. 5% is 25 grand. We'll even take it down. 5% of a $300,000 house. That will buy a lot of property in a lot of markets in America. Los Angeles, we're going to have to talk about upping it, but different places, different openings, right? And if you have an opportunity, an opening to come in at 300,000, put 15% down, 15,000 down. I'm sorry, 3%. That's 5%, and do it once again next year. The reason why I say once a year is because that's when you can buy a new primary and keep the old one.
yeah,
And if you're targeting properties that rent for similar to the mortgage payment, if I have a $2,000 a month mortgage, Make sure that bad boy rents for $2,100 a month. Whatever, just breaks even. And then play this out with me. In 5 years, you have 5 properties. There's no cash flow. You're just paying your expenses. There's no cash flow. And this is money that would be in your 401k otherwise. Well,
but a lot of tax deductions along the way.
100%. A lot of tax deductions, a lot of unspoken benefits there. And if you just experience normal market appreciation, 3 to 5% a year, scale that up for 30 years. That $300,000 home is going to be worth $1 million in 30 years. Pretty straightforward. If you guys go back to the 70s, look at what the average price point is in America. I think in the 70s, it was like $38,000 was the average single family home price. Something crazy. Now it's like $430, I think, $390, something like that. But if you fast forward to your first year of retirement, assuming you finance these on 30-year traditional mortgages, which is possible, your first year of retirement is 30 years after you bought your first home. Imagine you worked for 30 years. You worked from 25 to 55, right? At year 55, that house that you bought at 25 is now paid off because you're 30 years later. You paid it off and you never refinanced. I'm just making this easy, for example. Well, what do you have? What's your net worth? Well, the 401k, Christian, at that point in time, I can start taking monthly distributions. And after 30 years of contributing, I can distribute $3,000 a month comfortably. Okay. Awesome retirement plan. You going to be comfortable 30 years from now with $3,000 a month?
Right.
You sure? Right? You sure we don't want to get a little more comfortable than that? Like you might be able to live, but you want to be on a fixed income? I don't. Right? Yeah. Like I want to be comfortable. When I retire, like I want to go be traveling and have kids that I can support and like have some fun in life, right? Reap the rewards of what you sowed a little bit, right? So we got the little puppy making an appearance here.
Gorgeous.
The little boy. But staying in seriousness here. At the end of that 30-year period, now that rent that you initially rented it out for $2,100 a month, it's renting for like $4,000 now because 30 years of rent. Remember, people forget the property appreciates, but so does the rent. The rental income goes up. And even during times of crisis, recessions, you guys go look at the data of what happened to rent in 2008. Real estate houses prices went down, but rent went up. It actually got more expensive.
So now you're netting $4K a month from just that property. And let's just say there's $1K of upkeep you have to put in every single month because it's 30 years old. Let's just say that's probably not what you would have to put in. But even then, now you're netting $3K a month.
But now, fast forwarding, and let's say, I don't want that $3K a month because that was comparable to 401k. What I'd say is, hey, on year 30, you now have $1 million asset, right? 30 years of appreciation on a $300,000 house that has no debt. Number one, you could sell it if you want. Boom, you get $1 million in income your first year of retirement. 401k is not going to do that for you. Or what I think is more powerful, number two, you go leverage it. I take that $1 million loan and I go put a $600,000 mortgage on it. And I scale that mortgage to what the rent will still support, and I make it break even again. And let's say that's $500,000. $500,000 with a $4,000 monthly payment. That means in your first year of retirement, you took $3,000 a month that we were cash flowing, or $4,000, whatever, and you converted it to a $500,000 deposit, tax-free, in your first year of retirement.
Yeah.
In your first year of retirement. Now, we were talking about living on $3,000 a month. Can you live on $500K your first year of retirement? Yeah. I think so. Right?
And then you have another property coming due the next year.
That's exactly right. Every 30 years, you're just staggered. So in your house you bought in year 2 is now your refi in year 31. Year 3 is year 32, right? And you just do it. It literally is a retirement subsidy. And guess what? When you eventually pass away, sure, on a 401k, your kid would inherit it, whatever. But with real estate, your kid inherits the plan, which means 30 years later, they can be refinancing every year, right? Yeah. And they can use the proceeds from what you bought and they can go buy themselves and you can just start snowballing, right? And this is how people end with 30, 40, 50, 60, 70 properties. This is how they do it. It's not rocket science. It's a strategy that is actually achievable, because most people will go out there and say make more money because you got to put 20% down to buy each property. That's hard. With property values where
Very.
they are now, the average house price in America is around 400 grand. 20% is $80,000. 99% of Americans are not saving 80 grand a year. That's
Right.
not going to happen. But can you save 15? Maybe. Much more possible,
Yeah.
right?
I love
And
that.
that's why
And
I think that strategy is so powerful.
it's a great idea. My girlfriend and I have figured out how much we can save each year with our income, and it's assuming we are both gainfully employed. So I hope that can continue, because that's what we need to do in order to fund our retirement in the way that we want. Because again, yeah, maybe the and again, the stock market traditionally rises over time too. It's certainly not the worst play, but you aren't really building generational wealth at that point. I mean, I guess if you don't touch it, you pass it off to your kids, maybe, but you're not building an asset that's, first of all, the other thing too about primary residence, if you don't have investment accounts, it's not really an asset. Your primary home, I don't believe, is really an asset until the day you sell it.
Yeah.
Otherwise, it's just, I mean, you gotta live somewhere, right? So you gotta live somewhere, and people often think, well, I have this asset, I'm sitting on this asset. It's like, not really, unless you're downsizing, I guess, maybe,
Yeah.
and you pull some money out of it. Otherwise, you're just living where you're living. And so for those of us that are living in areas where, like LA, where we can't necessarily, 15K isn't maybe going to get us the ability for us to move around each year for a while and take advantage that way. So we need to look in other parts of the country where we aren't going to be able to live there because we live in somewhere else, but we can still employ the same strategy really anywhere, correct?
That's correct. Yeah. And obviously, the purchase prices in your area is going to scale, but so should your income, right? If you're living in
Right,
San Francisco, your income should be higher than if you lived in Louisiana, right? And that's nothing
right,
against Louisiana. That's just a fact, right? I mean, different markets
right.
cost more. So, and one a year may not be possible. Maybe you do one every 2 years. Maybe you do one every 3 years. But getting it on your radar to understand the possibilities that it unlocks utilizing a strategy like this, and how it can replace what traditionally has been told to us is like the tried and true investing method in America, which is the 401k, right? And IRAs and whatever. They're all investing in stocks, right? But sorry, I got a little puppy going crazy here, guys. But I just think it brings a different level of thinking. It's funner because I mean, I don't know about you guys, but I get more excited investing in real estate than I do buying Apple stock. Like
Yeah,
Apple stock isn't
definitely.
exciting. Like, oh, they're releasing the new iPhone. No way, it looks the same as last year's.
And
You
you don't have as much agency over the investment either. You don't have as
That's
much
right.
control over what that investment does, because you can beautify the property, you can make it more appealing. There are things you can do to increase the value of that of that rental, of the building itself. And there's a sense of ownership and pride too in this. I am building something that, again, it's funny. I've never. Well, I guess I could make an exception to this. That during the mortgage crash in 2008 and 9, that was a different situation, because those were a lot of loans that just shouldn't have been written, and
Yeah,
people who shouldn't have been getting those loans. That is not going to happen again. Well, we hope, because certainly banks have learned their lesson.
I
But
can tell you, being in the industry, it is a nightmare getting somebody a loan. It is so hard to get a loan that I don't believe another 2008 could happen unless we just slash all regulations, which maybe happens. I hope it does not.
yeah,
But it is incredibly difficult to get a loan nowadays. That a 2008 is intrinsically impossible to happen the way the system is currently structured. It's just impossible. We can't have a scenario like that take place again. Now we could have like an auto loan crash or different things like that, and that may be what we can discuss on future episodes. But we will not have another real estate bubble. It can't happen with the way that financing is structured nowadays.
so I was thinking that I've know a lot of people that own multiple investment properties. I have not heard one of them, and again, post that time when maybe people were getting loans they shouldn't have. or they shouldn't have been able to, rather, not that they shouldn't have been able to. And I've not heard one person say, "Boy, that was a bad idea investing in multifamily or
Yeah.
rent, income based." I literally haven't met one person who said that. Now, of course, not every investment's a good idea, but it. I mean, my brother-in-law has a property in Tampa. He bought it for, gosh, $130,000. It's right across from the stadium. He rents it out to mostly to people who short-term rentals, people that want to watch the game, during football season, concerts. He rents it out for short-term rentals. He only has to rent it out like 10 days a month to make his nut. And he makes thousands of dollars in net revenue every single month from like $130,000 purchase.
Yep.
It's never going to appreciate to any massive level, but it is great regular income. And one day, who knows? Maybe it will be worth something more. But regardless, it's kind of saved him because there was a time when he was in between jobs and he was like, oh shoot, I don't, oh no, I do have income coming in every month. So that's another reason to kind of keep it in mind is as long as and he purchased it outright because he had the ability to do that, so he didn't have to worry about a mortgage payment. So I guess he didn't really have a nut, so to speak, but he was paying himself back, and it's been a wonderful investment for him. And anyway, again, we all know people that have done this, and they rarely are, unless they just mispriced it and their rental prices isn't where it could be, and who knows, everyone can buy a lemon. But if you do your research, this is a pretty solid idea. So
Yeah.
I think, and you and David are kind of some of the biggest industry voices to sort of give this strategy away. And also, we want our audience to check you guys out as well, because you guys have your own mortgage lending brokerage, which is really exciting after so many years of being in the industry, and it's just been crushing it. The one brokerage is where I'd like everybody to go. So for your traditional clients, the traditional primary home resident buyers, or buyers rather, I want you to go to theonebrokerage.com. Give David and Christian an opportunity to earn that business, but also let's start talking about investment strategies to our primary home buyers and sellers, right? The people that are only putting stuff into 401ks. Have these conversations. Get Christian and David to talk with them as well and their team. They will help them, guide them through this process. This is really an amazing idea that I want our audience to deeply consider from a tax perspective and also a retirement perspective. It is something that just even today, doesn't get as much press and as it should. It's there's a lot of bad information out there too. So
Absolutely. Yeah, 100%. And there's, you guys have to be careful nowadays, because unless somebody is doing it themselves, providing a service, reputable source, you got to be careful. There's a lot of people claiming they can do a lot of stuff, right? I'm still hearing all the time that you can buy real estate with no money down. And sure, there's wholesaling and subject to and creative financing. Be careful, right? It's not the people putting 20% down that get slammed, right? It's not the people investing confidently, buying a primary every year, making sure that it rents well afterwards. It's not those people getting slammed. It's the people trying to skip steps, find the easy path. There's no secret sauce, right? It's hard work, it's fundamentals, and it's confident and defensive investing that gets you ahead. Somebody may get lottery, but if you buy tickets your whole life, you're going to come out below, right? You're not going to come out on top, right?
Right. Yeah, super well said, and great place for us to wrap up this episode this month. Christian will be back next month. Again, learn with a lender. Again, I want everybody to go to theonebrokerage.com. Give him an opportunity on your next client or your next purchase of your own. And they've got great rates. They've got great service. And these guys are people that buy a lot of properties. They know how to get deals closed. So let's reach out to them. They support our show. We want to support them as well. Give them a shot. theonebrokerage.com. One of the fastest growing lending in arms in the country. And there's a reason for that. There's a reason why these guys have hundreds of thousands, probably between you and David, you probably have over 1 million followers, I'm sure, between all your different social channels. There's a reason for that. So we love both you guys, and so grateful to have you on the show. And for anyone out there who doesn't have a great relationship with a lender, Christian and his team want to talk to you. So reach out to them, The One Brokerage, or even just to get a second opinion, right? getting a second opinion is a good idea. You know, we do tech audits on our stuff. We say, hey, how's our CRM stacking up to the competition? Yeah, we want to also check in with our lending. So let's do that. And on behalf of Christian and myself, thank you to everyone for supporting our show. Let's support our sponsors. Let's support Christian. And on behalf of our audience, Christian, thank you. We appreciate your time and all of the great ideas and investment strategies that you provide to us, as well as just great loan service. And we will see everybody on the next episode. Before you leave, please do one thing. Tell a friend. Think of one other agent that needs to hear this. Probably somebody in your office. Shoot them a link. It helps us grow. And also leave us a review. Whatever podcast app you're listening to us on, let us know what you think of the show. We read those reviews. We make changes based on your feedback. And we want to make sure that we're providing a good service to you guys. So tell a friend and leave us a review and let Christian help you out on your next deal. We will see everybody on the next episode. Thanks, Christian.
Absolutely. Happy to be here. Appreciate you having me.